Hey cousins, back with another video. On this video of WICK N WINS, we'll be covering liquidity, inducement, buy and sell stops, smart money traps, and so on. Most retail traders lose because they are reacting emotionally to what they see on the charts, chasing breakouts, selling dips, and jumping into setups without context. But those aggressive moves, they are often traps, carefully engineered by smart money, institutions, hedge funds, and banks that aren't trading the same way as retail. They are creating zones of liquidity, triggering stop hunts, and using volatility to force weak hands out of the market. That week you thought was a breakout candle, it was a setup, just not for you. In this episode of WICK N WINS, I'm breaking down exactly how to spot smart money behaviors in real time and avoid the traps that leave retail traders stuck. Look out for sudden moves into obvious support or resistance, long wicks that pierce structure before reversing, and fast imbalanced price action that leaves inefficiencies behind. These are all signs that smart money is active. To escape retail traps, you need to zoom out, align with the higher time frame buyers, and wait for price to confirm, not react. Enter on strength, not impulse. The difference between surviving and thriving as a trader isn't about having a fancy strategy, it's about understanding who's really in control. When you learn to recognize smart money footprints, trading becomes clearer. No more guessing, no more chasing, just precision, patience, and probability. If you are ready to stop failing or falling for fake outs and start reading the game the right way, this episode is for you. So let's get into it. So the concepts I would like to speak on are the hidden zones. This is where smart money plays. The real battleground lies not in the obvious support and resistance levels that most traders draw on their charts. Institutions and smart money do not respect these neat horizontal lines. Instead, they operate in hidden zones of liquidity. These zones often include the unmitigated order block where large institutional orders previously entered the market. The next one are fair value gaps. These are like areas that mark inefficiency in price delivery. The third ones are breaker blocks where failed structures are later used to lure unsuspecting retail traders. The retail eye often misses these zones, yet they are the exact locations where price is more likely to react from and where smart money positions itself. Next concept I would like to touch on are inducements. Inducements are a bait for the unaware. Before price reaches its true destination, smart money often sets inducements. These inducements act as a bait designed to lure traders into premature entry. For example, price may edge closer to a supply zone, hesitate, and then push higher, encouraging retail traders to chase buys. Or the market may create equal lows, convincing traders to short just before sweeping those lows and reversing upwards. Inducements guarantee that when smart money enters, there is a pool of liquidity to fuel their move. Inducements may also occur at a POI to stop hunt traders with extremely tight stop losses. Smart money traps. Smart money understands psychology better than any indicator could. They know where fear and greed are the strongest, and they design traps around these emotions. Common traps include false breakouts, which lure traders into chasing momentum, liquidity sweeps, where stops are cleared at predictable levels, and false trends, short-term movements that trick traders into ignoring higher time frame structure. All of these traps is always the same: to accumulate institutional positions while retail traders lose money. So I'm going to jump on the charts now and show you guys actionable steps and examples of how to spot liquidity on the market. So stay with me guys as I show you through it. Hi guys, so welcome back to the charts. For now, I want to quickly run you guys through how to identify liquidity, all the types of liquidity and how they may form on your charts. I'm also going to be delving a little deeper into the lower time frames because this is where I take my entries from, and liquidity is more prevalent on lower time frames because of the noise and rapid moves in the market. Also, I want to be showing you live examples of how inducements might occur, right? So let's get right into it. So as you can see on this, going into the 4 hour, take it easy. This was where we stopped on our last video, right? So we've already created this price movement, short-term price movement, by the way, right? So we can see this is the higher time frame. Price reacted from this zone to give us a minor sell up to the upside before continuing all the way down, right? I would like to show you some possible buy opportunities we would have gotten due to this bounce off of this OB, that's order block, on the higher time frame, right? As you can see, guys, narrowing down, this is the very valid OB, broke structure to the upside, came back, reacted from this point and gave us an entry. So let's go back, let's go down to the 30-minute. If we were on the chart this day, this is basically what we would have caught. So looking at, off of just looking at my bear charts now, you'll be wondering what these things, these blue things are. So I want to introduce you to the first style of liquidity, and they are called, these blue patches on my charts are called the Asian session. This is the Asian session. This is the Asian session of another day. This is the Asian session of the 16th of July, Asian session 17th of July, Asian session 15th of July, right? And if you notice, the Asian session usually has like it's usually ranging, if you notice, and it's ranging means that there's liquidity at the top and at the bottom. Note, it doesn't always happen every time, but most of the time the Asian session ranges. So this is an opportunity for London session traders and New York session traders to capitalize on the range. You understand? So I label liquidity as pound sign. So anywhere you see this is what I mean by liquidity, right? Liquidity means money that's resting basically in the charts. So this is liquidity resting here and liquidity also resting here. Now I want to introduce you to another concept called equal lows and equal highs in the market, right? When you see price forming equal lows like this, like being on a straight line, you see wicks lining up together like this, means that there's liquidity around here and it should be induced, right? If you notice, this was the Asian low and it wasn't taken out. If you notice, it wasn't taken out completely, right? Price took out the top and you know that it will come back to take out the bottom, but price kept ranging, so price took it out, if you notice. So all of these are called equal lows. You can call them EQLs or EQH, but in this case it is an EQL, right? If you notice, price took out this liquidity, induced this liquidity basically. We are on the 30-minute chart, so let's go down to see in more detail what price did. So as you guys can see, we're back. If you notice, price gave us these velocity candles. This was probably news. I don't know why this move happened, but this was price giving us this velocity candles, 1 2 3, then broke structure with aggression. So there was a break of structure around here, right? As you can see, like we're building our bias little by little, right? Yeah. Then this was another day, another day was gone. Like this was the trade for the day. Whoever caught this, happy for them, right? So price gave us another liquidity. If you notice, this is another day, Wednesday 16th of July. This is another liquidity sitting both at the top and at the bottom. Note that we are now on the 15-minute time frame, so we see price a lot sharper. So like having this knowledge of Asian range, because this is our Asian range, we know that okay, price has come back to liquidate this. So yeah, this has been liquidated, right? So the normal retail trader would just expect price to react and start moving up, right? But that's usually not the case, you know. So price came close to this OB that has been created. This is now our area of interest or point of interest, right? So we are not looking to take any buys until we get further confirmation about, okay, this is an actual entry and we're going to take our buys from here, you know. But instead, what does price do? Price comes, act like it's about to start going up, then comes back and liquidates this. So this is the second type of liquidity that we call engineered liquidity. This is the type of liquidity that smart money engineers in a way that it wants the early buyers to come in, create liquidity for the main move of the day, right? It wants the early buyers to come in, create liquidity to fuel the real move, right? So these people were liquidated as early buyers, right? It took them out because usually they would have their stops tight, you know, after it gives them this this signal to buy, to go long, you know, that will be the case there. So yeah, it could also be that other smart traders wanted to take their entries off of this fair value gap, because there's a fair value gap somewhere around here, right? I will not delve into what fair value gaps are on this episode, but there's a fair value gap here. So smart traders might want to delve into that fair value gap, and they got stopped out immediately, causing what? More inducement. So price then tapped into our OB, as you guys can see. So this is now a very valid setup to look at and be like, okay, since it has liquidated here, this is one liquidity taking, it has already taken this as well. Now it has engineered more liquidity, so it makes the trade a very high probability setup for buys. You understand? So what next we'll be looking out for is, okay, when next should I target as the next potential liquidity target? It will be these Asian highs that are yet to be liquidated. You understand? So going back now, I'm not teaching you how to get into trades today, but if you can see, if we entered from somewhere around here, because this is the time I enter my trades, this is exactly 8 o'clock, the beginning of the day. As you guys can see, this was the first trade of the day, exactly 8 o'clock, right? Usually TP will be at the top of this, and you expect to enter somewhere around here, stops below here, and you let the trade rip to the end. And as you guys can see, the trade happened just how we expected, because enough liquidity has been engineered to fuel the real move to the upside. So this is basically like it in a nutshell. So I'd like to run through the next, right? Because I'm yet to touch on engineered liquidity. Okay, I've touched on engineered liquidity. I'm yet to touch on SSL and inducement as well. Those are the two that are left before we call it a night tonight. If you stay this long in the video, I really want to appreciate you, and this is the reason why you are going to be successful on your journey. So the last concept I would like to cover for tonight is inducement, and it's it's a very important concept because it's one that sometimes you really can't avoid, because the market is unpredictable. We work with probabilities. So let me quickly run you through one of the trades I took. This was the trade I took on GBP USD. I think that was on the 14th of August 2025. So if you notice here, this was an Asian range still, right? But if this is at a higher time frame supply, right? So I already knew that, okay, my higher time frame bias is for sales. So all I needed to do was just get the sales during my time frame, and we'll call it a day, right? So if you notice, this was already done, right? Price came this way, broke structure to the downside, engineered liquidity, came back to the other block. I thought this was the this was price inducing this liquidity resting here. Let me draw a line so you guys see it, right? I thought this was the inducement. So yeah, I became really convinced about this trade because he also gave me a BOC. I'll cover that in the next videos. But it gave me a BOC, also like enforcing or strengthening my bias, right? So after this BOC, it still continued moving downwards, and I was really convinced about this trade, and I was willing to go all in. So I got in on this trade, right? Then price went in my favor for a bit, then came back and induced me, taking me out of the trade, then going all the way and hitting my TP. So that is a classic inducement. So what he did here is there was built up liquidity around here. Yes, I thought this took out that liquidity, but it didn't. Apparently, smart money had other plans, right? So what they did here was there was a lot of liquidity build up at this point. Let me show you. A lot of liquidity build up at this point. Price came back, engineered liquidity. This wasn't enough. This was still more liquidity. That was me being liquidity for the market as well. So price actually did come back, gave me like a fake out, made sure to take out all this liquidity, then still closed inside my OB, then continued to my TP. So that's inducement for you. It's a classic example of inducement, and it's the best way I can actually explain inducement to a beginner. If you stay this long, thank you. I really appreciate. I think that's all for today. So on the next episode, I will show you more practical steps on how we can bring all of these things together. Liquidity, everything, that all the concepts I've taught you, I'm going to bring it together and make it all make sense and see how we can actually take a trade together. See you on the other side, guys. Peace. That must have been a really long video, but I want to conclude the video by speaking about escaping the retail traps. Escaping these traps require a new mindset. First, trader must study liquidity, not patterns. Instead of asking whether support will hold, ask where the stops are and how the markets might use them. Second, begin to think like smart money. If you had billions to move, where would you enter? Third, cultivate patience. Do not rush into trades. Wait for the sweep and the trap to trigger before taking a position. Finally, learn to use higher time frame to anchor your bias. The institutions always move in alignment with structure on the larger scale. The market is not random. It is carefully engineered, designed to mislead the majority while rewarding the few who understands its mechanics. Every trap is intentional, every inducement calculated, and every liquidity sweep part of a broader strategy. The key to consistent success lies in training your eyes to recognize hidden zones, anticipate inducements, and step into trades only after retail liquidity has been harvested. By doing so, you move away from being the prey and begin trading in steps with the predator. This is the essence of trading mastery and the arts of turning wicks into wins. If this episode opened your eyes to how smart money truly moves the market, don't just stop there. Make sure you like this video, subscribe to the channel, and turn on post notifications so you don't miss the next breakdown. Drop a comment below, and lastly, keep practicing, keep getting better as a trader, and don't forget to play the game to win. See you in the next one, guys. Peace and love.